Welcome to this installment of Clarifying Tax Situations with attorney and CPA David W. Klossing.
What are the basic tax implications of cryptocurrency? The government, at least for tax purposes, has classified cryptocurrency, Bitcoin, alt, light, etc., as property. Similar to owning shares of securities, stock, bonds, etc., this places onerous record-keeping requirements on those that invest or do business in cryptocurrency. Therefore, records need to be maintained in order to track the basis of each Bitcoin. However, the WAS sale rules likely do not apply to Bitcoins because they do not specifically meet the definition of a stock share. The government, at least for tax purposes, has classified cryptocurrency, Bitcoin, alt, light, etc., as property. Like trading in shares of stock and bonds, etc., requires fastidious record keeping to track your gains, losses, and basis, the same requirements are placed on you when you trade in cryptocurrency. A lot of uncertainty surrounds the taxation of cryptocurrency. The government's last publicized guidance on cryptocurrency as of the date of this taping was in 2014. Immediately after this guidance was given, the AICPA wrote a letter asking lots of questions about tax implications that weren't addressed. For instance, does 1031 apply? Can you do a like-kind exchange with different types of cryptocurrency? We'll cover that in depth later. It seems to be rational that the normal basis rules that apply to other types of property would apply to Bitcoin and cryptocurrency. Therefore, Bitcoin and cryptocurrency users should have the option to sell their assets on a first-in, first-out basis, on a last-in, first-out basis, or a selective cost basis method, maybe even average costing basis. In a rising market, LIFO, last-in, first-out, will produce the lowest tax liability. However, this may not get you long-term capital gain treatment. In order to get long-term capital gain treatment, which involve preferential tax rates versus ordinary income rates, which are usually higher, you have to sell a security that you've held for a year or longer. I'm going to use the word security in Bitcoin and cryptocurrency interchangeably because the SEC has defined cryptocurrency as a security. In a falling market, the FIFO method, first in, first out, will ordinarily produce the lowest tax liability. Taxpayers that are paid in Bitcoin, for services rendered or mining, those payments are subject to self-employment tax at ordinary income tax bracket rates. This means that if your net self-employment income is $100,000 or greater, you're going to pay 15.3% self-employment tax before you even begin to pay income taxes, state or federal. It also means that income will be taxed at the ordinary income tax brackets, not at the preferential capital gains rates. Businesses and individuals that make payments to anybody that isn't a corporation, for the most part, are subject to 1099 reporting requirements if they pay somebody over $600 in one tax year. Also, the backup withholding requirements could apply, i.e. if you were making payments to a non-resident alien, you may have to send backup withholding into the government. Recently, a bill was proposed that would create tax exemptions for cryptocurrency transactions under $600. This bill did not pass.